The idea of an incorporated business is a truly capitalist concept. Our laws allow us to create a legal entity on paper that has many of the same rights as a human being. The corporation is legally responsible for everything it does. A corporation can buy and sell merchandise, sue or be sued in a court of law, and invest money in other business endeavors. In many ways, a corporation is like a businessman without a body. Why is that important? If you own a candy store and are organized as a sole proprietor, you are personally responsible for what happens in your store. If a customer slips on a wet floor, breaks their leg, and sues the store, you, the proprietor, would be financially responsible. If you didn't have the money to pay off a legal suit, the courts could force you to use your life savings and sell your car or house. If you were a corporation, the customer who slips and breaks their leg would sue the corporation. Your personal assets would be protected in most cases. The corporation is formed when a group of investors pool their money together. These investors are the original owners of the corporation. There can be one owner or there can be many. The new corporation will issue shares of stock to the investors. The stock is distributed among the investors in proportion to the amount of money they invest. For example, assume there are two investors. One of them invests $800 and the other invests $200. If 1,000 shares of stock is issued, the $800 investor would get 800 shares and the $200 investor would get 200 shares. Unlike a sole proprietorship or partnership, a corporation can continue to exist if the person who started it dies. That's because the stock can be sold or given away. Whoever legally owns the stock is an owner of the corporation. Let's go back to Mike and Peggy. They have decided that a partnership is not the best way to organize, and they decide to incorporate. They want to attempt incorporating over the internet, and they do an online search using the phrase "incorporate online." Mike and Peggy get several hundred matches, promising them incorporation at rates that range from $79 to several $1,000s. Many websites want them to incorporate in the state of Delaware or the state of Nevada because those states have favorable tax laws. Mike and Peggy decide that because they're so new to this incorporation idea, they would feel much safer using a local attorney. They talk to several attorneys and find one who agrees to do the incorporation for $800. That includes all legal fees, document preparation, and state filings. The first thing the attorney does is a name search to make sure that the corporation name isn't already being used in their state. Mike and Peggy wanted to use A1 Landscaping, but there's already a corporation operating with that name. The attorney suggests they use A1 Land and Lawns, which pleases Mike and Peggy because it'll give them better Yellow Pages placement. The attorney drafts a certificate of incorporation, which is filed with the State Division of Commercial Recording in their state's capital. The attorney also prepares a document called the Corporate Bylaws, which the state requires as part of the incorporation process. Corporate bylaws list nuts and bolts information, such as the office location, date of annual meetings, and how shares are distributed. The corporation has its first meeting of the board of directors at the attorney's office, where all the documents are filled out and signed by Mike and Peggy. Mike and Peggy are really happy with their new corporation because they're going to buy their health insurance, their life insurance, and their disability insurance through the corporation with tax-free money. The money is tax-free because the corporation is going to pay the premiums and deduct the cost as an expense. When they were sole proprietors, Mike and Peggy had to pay their premiums through their personal accounts. The company that Mike and Peggy have set up is called a C Corporation. This is the form of corporate ownership that most large companies use. Mike and Peggy go to meet with an accountant to set up a bookkeeping system. This is their plan. They're going to each collect a salary of $40,000 a year. That will be through a paycheck which will have income tax, Social Security, and other payroll deductions taken out of it. They calculate they will have an $80,000 profit left over at the end of the year. They plan to take that $80,000 as a dividend. Although you must pay income tax on the dividend, it is not subject to Social Security tax. But the accountant tells them something else they didn't know. That $80,000 will be a corporate profit, and it will be subject to corporate taxes. So now Mike and Peggy are going to pay a high corporate income tax rate on the $80,000 profit. That leaves them about $60,000 for their dividend. Then, after they take that money for themselves, they are going to pay personal income tax on it again. In other words, that profit is going to be taxed twice. The accountant tells Mike and Peggy about a different kind of corporate structure they can set up called an S corporation. By setting up as an S corporation, they can avoid the double taxation. To become an S corporation, all they need to do is file a special form with the IRS. The S corporation has several requirements that differ from a C corporation. The S corporation can only have up to 35 shareholders. The S corporation is treated like a partnership for tax purposes. Profits pass through the S corporation directly to the owners and are taxable at the owner's tax rate instead of at the higher corporate tax rate. The biggest downfall for Mike and Peggy with the S corporation is that their medical insurance premiums are no longer tax deductible. They do some more calculations and figure that the savings from the double taxation is more valuable than the tax savings on the insurance premiums. They fill out the form and become an S corporation. In many cases, the story could end here, but Mike and Peggy run into another problem: the paperwork. They have to do monthly payroll reports, quarterly payroll reports, quarterly income tax returns, unemployment, disability, and workers' comp returns. They've got so much paperwork to do, they start wondering, why did they ever decide to incorporate? All they wanted to do was run a business, make some money, have some protection from getting sued, and live a normal life. Then one day, Mike and Peggy learn about another type of company they can set up, the limited liability company.